Hi, welcome. I'm Raj Venugopal. Today we are going to talk about stock evaluation, that is, how to evaluate a stock. This is a common question that every investor asks to themselves, and most of them are trying to get answers from an expert or someone who can give them an accurate or a reasonable response. The worthiness of a stock starts with the evaluation of the business you are interested to buy. It starts with the brand name, products and services offered, and the customer need for the products and services. When these requirements are rated high, the next logical step is to look into the past performance. Past performance does not guarantee future success, but provides a good amount of information on how the business is run till date. Business past performance is like a conduct certificate. It gives the confidence for the new investor to invest their hard-earned money. When the business clears the confidence test, the next step is to analyze a stock technically using publicly available data in predicting its future performance, also known as technical analysis. Now, there are thousands of points available. If you overanalyze or overthink using all available data points, then you will end up paralyzing the outcome. So I came up with 12 data points that served me pretty well till now. It is important to understand the definition and their association in the right context to get the most accurate information as possible. So here are the details. 52-week range. It is the highest and the lowest price at which the stock has traded in the past 52 weeks. Stock price is the market value of each share. Book value per share is the accounting value of each share. Market cap is the market value of the shares outstanding of a public company. P by E is price to earnings ratio. EPS is the earnings per share. It is the portion of company's profit allocated to each share of common stock. Dividend and yield, I give a lot of importance to the yield because yield is dividend expressed as a percentage of current share price. Price to sales ratio, that is that is based on TTM, that is trailing 12 months, and price to book value is based on MRQ, which is most recent quarter. A low ratio in both the case, price to sales ratio and price to book ratio, in both these cases, low value indicate undervaluation while a high value suggests overvaluation. Now the next is revenue. Revenue is the total amount of money that is brought into company by its business activity, and total cash is too little is not good, and total debt too much will kill the business. Now, let's do some stock evaluation. So, the best way to compare or evaluate a stock is to compare the stock with its closest competitor. Get the facts and figures side by side and do the comparison to determine the winner. It's not easy, but it's not hard either. In addition to the key data points, there are other financial statements that are worth a review. Financial statements such as income statements, balance sheet, and cash flow statement can provide much more information. For more detailed report, please check out Yahoo Finance or Google Finance. Now let's do some comparison. We are going to compare case 1 Google versus Apple, case 2 is AT&T versus Verizon, case 3 is GoldCorp versus Barrick Gold. We are going to do the comparison based on the data for the period ending September 26, 2015. Case 1 Google versus Apple. Now if you look at the 52-week range, that's a good place to start, and winner is not applicable. Stock price, the winner is Apple because it is closer to the 52-week low range. Book value per share, winner is not applicable because we are going to use the price to book ratio instead. Market cap, higher the value, safer is your investment, so winner is Apple. P by E ratio, lower the value, better is your investment, so the winner is Apple. Earnings per share, higher the value, better is your investment, so the winner is Google. Dividend and yield, There is no dividend from Google. There is 1.82% dividend yield from Apple. So winner is Apple. Price to sales ratio and price to book ratio, both lower the better. So when it comes to price to sales ratio, Apple is the winner. Price to book ratio, Google is the winner. Revenue, more the better. The winner is Apple. Total cash, more the better. Apple, but in this case, Apple is a dividend stock, whereas Google is not a dividend stock. So it's not a good data point to compare. So winner is not applicable. Total debt, lower the better. So winner is Google. So the final outcome is the winner is Apple. Case 2, AT&T versus Verizon. Now if you look at the 52-week range, the winner is not applicable because this is a good starting point. Stock price, the winner is AT&T. That's mainly because it is closer to the 52-week low range. Book value per share, it is winner is not applicable because this is one of the point that we cannot really compare. Market cap, the higher the better. Winner is AT&T. P by E, winner is Verizon. Earnings per share, winner is Verizon. Dividend and yield, higher the better. So AT&T provides 5.84%, so winner is AT&T. Price to sales ratio and price to book ratio, lower the better. So when it comes to price to sales, winner is Verizon, and price to book, winner is AT&T. Revenue, higher the better. Winner is AT&T. Total cash, higher the better. Winner is AT&T. Total debt, winner is Verizon. This, in the case of debt, it should be too little, so that's the reason why winner is Verizon. And let's see who the winner is. A winner is AT&T. Case 3, GoldCorp versus Barrick Gold. This is again a riskier investment than the other two cases. Let's get started. 52-week range, both looks good. Winner not applicable because this is a good starting point. Stock price 13.37 for GoldCorp, Barrick Gold 6.57. Winner is GoldCorp. Book value per share, its winner is not applicable because that's not the data point we use to rate. Market cap, higher the better. Winner is GoldCorp. P by E ratio, both are not applicable. Earnings per share, both are negative, so not good at this time. Winner not applicable. Dividend and yield, higher dividend yield is preferred, so the winner is GoldCorp. Price to sales ratio, the lower the better. Winner is Barrick Gold. And price to book, lower the better. Winner is GoldCorp. Revenue, higher the better. Winner is Barrick Gold. Total cash, higher the better. Winner is Barrick Gold. Total debt, lower the better. And the winner is GoldCorp. And let's see who the winner is. The winner is GoldCorp. Now, thank you for listening. Wish you all the best. And as always, happy investing. Thank you. Bye.